Welcome to Stock Talk with Nico Criticos. Today we are going to be going over BGS, which is B&G Foods. And the reason I'm wearing an Indian headdress is because it is Halloween or Halloween weekend. And so here we go. We got B&G Foods. This is a company that specializes in owning a bunch of different food brands, which you can see here. They own Cream of Wheat, they own Crisco, Green Giant, Ortega, and all these different brands. Okay, Cinnamon Toast Crunch, SkinnyGirl is another popular one. And see, the list goes on and on. Twix, they have a partnership with Weber Grills. And so I think their number one brand is Green Giant, I believe. I think Green Giant and then Ortega is their big ones. And so that's what this company does. But the main reason I own this stock is just because of how good the dividends are. So as of now, I own 80 shares at an average cost of $29.60. And as you can see over the past year, the stock has spent a lot of time down in this $28, $29 range. It keeps coming down. And it's had a couple spikes up into the 30s. But the last 6 months or so, it's been stuck around this $29 mark. But if you look at the last 5 years, you can see it's come down a lot from its 2017 highs. And the reason that is because of they're actually making less money now. But I think the company is still in a healthy position, and I don't see all these brands going away anytime soon. So that's why I feel like it's a pretty safe bet. And so we're going to go through Nico stock market checklist here, and we're just going to analyze this company and see, is it a smart company to be invested in. So first up on the list, we have net income growth over the past 3 years. And as you can see here, this is actually not going to get a check because net income has actually gone down. It's gone from 217 million 4 years ago to 220. In 2020, it was 130 million. So that's where we have one of the problems at. Next up, we have revenue growth. And this one I could give a check because yes, they did grow revenue. So this one actually gets a check. Is the stock down? Since this is a mid-cap company, it's going to have to be down 35%. And I mean, I would say over the past 5 years, it is down over 35%. So we can give that a yes. A healthy return on capital and return on equity. We can find that right here. Return on capital of 8%, not the greatest. Return on equity of 13, that's like average. That's nothing too great. That's a really tough one. That's one that I would. It's kind of right in the middle. I mean, it's not bad. It could be worse. At least it's not 1% or something. So we can give that a yes. That's an iffy one though. Are they innovative? Not really. They just make simple food brands. Smart, focused, trustworthy management team or founder led. Well, beginning of this year, they got a new CEO, Casey Keller. And so I don't know a ton about this guy. I have not read a bunch, but I do know that he came from being the CEO at Peet's Coffee, which is a huge, one of the biggest coffee companies in the world. So that's a good sign there. But other than that, I'll have to do some more research. But they're getting a good CEO. So we'll see what happens. We can give that that one's iffy too, but we'll give it a yes. Healthy profit margins. Profit margin of 5.5%. I can see where this is a low margin business. If we compare that to something like, what could we compare that to? Let's compare that to maybe a Coca-Cola, or let's see what Coke's is. Coke's is 4%, so it's similar. So that's for that type of industry, that's probably what it is. So we can give that a yes. I mean, that one's iffy though, because that one they're barely making a profit. Healthy free cash flow. You can also find that here. No, let's look right here. So free cash flow over the last couple of years. This is where we kind of have a problem again. As you can see, it's super up and down. 37, 209, 46, 281, 101. That's not healthy. That is not healthy. Industry is growing. Is the industry growing for their type of brands? I would say yes, because they're getting into new things like SkinnyGirl and Weber Grills, and they have tons of different, they have tons of different brands. So they are expanding. A low forward PE, this company trades at they traded a low forward PE of 13.4. And let's compare that to Coke. So Coke trades at, so trailing PE of 17, just right around there. Pretty much the same thing. More long-term assets than long-term liabilities. One problem I do have with the, we'll get to that in a minute, but one problem I do have with this is, so let's see, if we look at their long-term liabilities to long-term assets, we can see long-term assets of 3 billion, long-term liabilities of 2.7. That's cutting it kind of close. But it is more current assets and current liabilities. I believe this one is also a yes. Current assets 750, current liabilities 218. Okay. Share buyback or dividends with a low payout ratio. Yes, we do know this has a nice dividend of 6.5%, as well as a payout ratio of, well, 110% is not healthy. That's a bit of a problem, but it all depends on their net income, because the net income fluctuates so much. We saw it go from 40 million to over 200 million to now it's 100 million. So because they're paying out 120 million a year in dividends. So on the year that it's 200 million of income, then we're looking good. But on a year like 2021, where income was lower, we're not looking good. So that one is tough. But let's see how the number of shares is doing. Share change plus 1%, not the greatest, but that's a tough one. That is a very tough one. Hedge funds. Are hedge funds or insiders buying? Well, if we look here, we can see that hedge funds are not buying, and insiders bought 10 insider transactions right around this $30 a share mark. So that's not a bad sign there. We can give that one a yes. Then increasing equity. I know this is this is the problem. This is what I don't like to see. But as you can see, over the past 4 years, it's gone from 880 million, 900, 812, 831, and now we are at 841. So it's gone down over the past 4 years. That's not good. Diverse revenue streams. Yes, they own so many different brands. They're in a ton of grocery stores. So that one is going to get a yes. Now, let's see how many yeses we have. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So now, see, here we go. It's supposed to hit 12 out of the 16 for it to be a buy, and it only hit 11. So technically, this would not be a buy. That's what makes it very iffy. What would change is when this goes to if their net income goes over 100, and let's say if they can hit $150 million of net income, then this is going to turn into a yes, because then that will be a high dividend with a healthy payout ratio. And so that's what this really depends on. But that's why I have not made a huge position in this. I only bought, I put a little over 2,000 in, which is smaller than most of my other positions. And so the reason that is because I can see this dropping even more to, let's say, maybe $20 a share, like how it did back here. And it depends on what their net income is. I have to see some net income growth to make that payout ratio look healthier, and to make the company needs to be growing its equity. And then once those things happen, then this will be a healthy company to be in. But that's why I'm kind of keeping it in a small position. But the dividend is so nice right now that I feel like it is a safer one to be in. But that's my opinion on this company. Let me know what you guys think.